This episode of It's Your Call is one of a series dedicated to facing the mortgage crisis in Southern California, brought to you with the support of the Corporation for Public Broadcasting. Good evening, I'm your host, Roger Bowman. Tonight, along with foreclosure prevention, we'll also cover the difficult decision of whether to walk away from your home, which, as we'll learn tonight, is probably the best decision for many homeowners. Our guests this evening are Ester Cadavid, Senior Vice President for the Los Angeles Neighborhood Housing Services, and Ben Garcia, Supervisor of the Mortgage Default Counseling Division of the Inland Fair Housing and Mediation Board. We invite you to call with your questions of tonight's guests. The toll-free number is 866-367-5827. Esther, let's begin with you. How long have you been with your organization? Tell us a little bit about it.
I've been with Los Angeles Neighborhood Housing Services for almost 8 years now, and LANHS is an affiliate of NeighborWorks America, and that's our national affiliate, and we are the NHS, and we have been around for 25 years in trying to build homeownership rates among diverse communities. Our niche population is low to moderate income families, and in this economy, in one fell swoop, all the homeownership rate has been decimated.
So you've worked for 25 years trying to get people the opportunity to get a home, and now you're actually having to counsel people about possibly going away from their home in some cases.
Right, and really helping them to transition with dignity if they have to, and in cases where there is a loan modification or refinance opportunity, fighting and advocating with the servicers so they can stay in their homes.
And Ben, tell us about your organization.
Our organization, we're a HUD-certified nonprofit counseling agency. We've been around for about 30 years. And the division that I'm in, we are the Mortgage and Default Counseling Division. And our mission there is to educate our clients, whether it's first-time home buyers or whether it's trying to get a modification and either making that decision whether to keep their home or to walk away.
So let's start talking about, we'll talk about whether somebody should make that decision to go ahead and accept that their home is going to get foreclosed on or look for a soft landing, as a lot of people call it. But tell us, if they make that choice, are they locked out of home ownership forever? I know you're talking about first-time home buyer opportunities.
Correct.
Isn't there something where there's a definition of first-time home buyer that doesn't necessarily mean it's technically their first home?
Right. You'd have to technically not be a homeowner for 3 years.
So if you rent for 3 years, then you can qualify for some of the government programs that assist you in getting a home as a first-time home buyer. Is that right?
Correct.
So all is not lost. If you do have to lose your home, there's a chance that you could go back and get a home again in as little as 3 years.
Oh, definitely.
But you're smiling, Esther.
Yeah,
there's some realities there. There's some qualifications. Tell us about those, because that's an area that a lot of people don't explore.
Right, and I think it's about the families that are losing their homes. There are families who are young in their 20s and their 30s, and then, there's a whole group of, seniors that have been really suffering through this crisis. And so when you talk about walking away from their property, walking away from their house, their lifetime home, it's a very difficult decision. And are they going to be first-time home buyers in 3 years? Do they even have 3 years left? Their 70s and their 80s. The bottom line is that the way that it is right now, in order to qualify for an FHA loan, you have to have credit, you have to have down payment, you have to have the income. And so while 3 years sounds, is the correct answer, realistically, it may take a lot longer. So what you do in this crisis will determine what happens to you, 5 years from now, 10 years from now.
So what you're recommending then is that somebody who's lost their home, they make themselves feel better by getting a fancy new car that they can barely afford. Is that it?
Absolutely. I think that we've learned a lot about what is a good decision in terms of what is a good loan and what is a good borrower. We really believe at LANHS that home ownership is a privilege. It's not a right, and it's not something that just anyone can get. You have to work for that privilege, and so in order to sustain your home ownership, and not lose it, next 2 years down the line, you have to be able to have the income. You have to have the credit. You have to be able to sustain that. And the reason we're in trouble is because we have a lot of homeowners that didn't have the sustainability, and that's sad because they were sold the American dream.
Well, let's talk a little bit about selling the American dream. I know that a lot of organizations, and yours is one of them, were actually trying to push for people to get that home, because before this bubble collapse, it was deemed that the best asset you'll ever own, the best investment you'll ever make in your life is going to be the home that you live in. So people were supposed to not only get the American dream, but they were also supposed to get their retirement from the asset that they would build up, and nobody saw housing prices declining like this. I remember the federal government even instituted programs to try to get people that were just edging into qualification into a home because it was deemed as their best investment. Do you feel a little now like organizations were too aggressive?
Well, I still believe that we build generational wealth through our real estate, especially in California, and that I'm Latina, and for the Latino community, and I'm going to speak for a lot of other minority communities, that we were able to educate our kids by having that home, that real estate. We were able to age in place. We were able to have so much more, and just cross generations. The wealth that you build and hand down to your younger generations really had to do with your real estate. That said, the homeowners that we put into homes, we did responsibly. Financial education was very important. The problem wasn't that there were products there for that niche. The problem was that was abused, and there were predatory loans, and that there were, I think, you will agree that there were loans that probably should never have been done, and people bought into the American dream because it was sold, and that's what I want. I'm here. I want a house. And
that's probably the most common mistake that people have, is that they weren't educated on the type of loan that they were receiving. And that's probably one of the biggest things that we do at our company is we educate them on the type of loans they have. So whether even if they have to walk away from that home in future time, come back and purchase another home, they know exactly what it is that they're signing and what they're looking for.
All right. Now, we've run 12 weeks now of talking about the mortgage crisis, and it's part of a series of 16 weeks. Nonetheless, there are so many people that are facing this obstacle that we get callers right away, and that's the case here. So we're already going to take some of the calls that have come in. Thank you for holding already. Alva from Coachella Valley, what's your question?
Yes, I have a question. I don't want to lose my home, and we're in the process of short selling the house. Is it time for me to save my house even though it's for short sale?
Good question. Okay, she didn't give a lot of specifics in this case, but what are the considerations that somebody should consider but in deciding whether or not to go for loan modification, or deciding whether or not to go ahead and let their home go into foreclosure or an alternative, such as short sale? And talk a little bit about short sale as an alternative.
Well, I think the first thing a couple should do, whether it's a couple or a head of household, is first determine, do I want to keep this home or don't I? If you decide you want to keep it, then you definitely want to try and do a modification and try every avenue there is to try and keep the home before you consider trying to transition out of the home. Short sales.
Ben, isn't it fair to say, though, that everybody wants to keep their home? So just wanting the home, is that the right criteria?
Not everybody. The majority of people want to keep their home, but there's some people out there that feel like, I don't want to keep the home, I just need that reinforcement that it's okay to lose my home. So sometimes they're just looking for an outlet.
So what you're saying is some people know that they're too underwater.
Right.
The unfortunate reality is that the housing market has declined in price, so they don't have the equity there. And maybe they have one of those option arms where they've been paying interest only, and they know that it's going to go into the proper principal plus interest payment, and they know they're not going to afford it. Esther, can you lend in?
Yeah, and at the end of the day, it's about the quality of life as well. So I see families that they're doing everything possible by any means possible. That kind of philosophy that I'm going to try and keep my house regardless of whether I'm going into bankruptcy, my kids and my marriage is falling apart. Bottom line is that it's a personal decision, and you need an advocate, you need a counselor, you need someone who has got experience who can tell you, these are your options. Under the Obama plan, short sale is an option. That's because the loan modification wasn't going to come through for you. So short sale, I think, is a good option if in fact you cannot get modified. So there's a four process: refinance for people who are current. If you can't get refinanced and you're current, or if you're delinquent, there may be a possibility for a loan mod. If those two things go away, then there's short sale, and then lastly deed in lieu. What you want to do is avoid the foreclosure. But at the end of the day, is if you've exhausted the first two, then short sale may be the best option for you, and only you can make that personal decision.
So let's say somebody made that decision, but they didn't get the counseling that was out there. They didn't avail themselves of that resource, and they decided to go for a short sale because they were threatened with foreclosure. Is it too late for them to look to the housing counselor such as yourself and try to begin a loan mod process if they're already inching towards a short sale?
I don't think it's too late. It all depends on where they are in the process. I think we've seen people that go back and forth, and certainly even families who got modifications or did something prior to March of 2009 when the Making Home Affordable program began. We're revisiting things, but again, it's on a case-by-case basis.
Okay. I'm going to go out. Sorry, Ben. I'm going to go out to another caller. Tracy from Paris. What's your question?
Hi. My question is, my husband and I got into a pretty good loan. It was a 30-year fix. Well, it is a 30-year fix. And, of course, we had a different, financial situation came up, and, unfortunately, it's been reduced. So we went to our loan company and asked, could they do a modification? Well, if we didn't meet their debt ratio standards, then, of course, we would be denied. From what I understand, their mentality is they would go ahead and deny it because they're just trying to put off the inevitable, which is foreclosure. So is there any other type of avenue or something else that we can do? Because, we don't want to lose our home. It's just because of unfortunate circumstances. We're not behind. So
Tracy, let me ask, are you saying that you were in a trial modification when you were told that yours would be denied?
We were in the process of the modification, right. And then we actually started going through with it, and they said, due to your debt ratio, unfortunately, we're not going to approve the modification, which is unfortunate.
Thank you, Tracy. So talk about that a little bit. I know people that are doing a loan modification, the first step is they submit the package, and somebody that receives the package gives them some indication, some hope that perhaps it'll go through. Very often I've heard because the banks want you to bring it current before they tell you it's denied. Other people say they've gotten into the trial modification, which, talk a little bit about that, and then they fall out. And I didn't think people were supposed to fall out once they're in the trial. Tell me about that, Esther.
I know that the trial mods are pending approval. And so when you get into a trial modification, there's also a clause that you have to call a HUD certified agency and get some counseling. But you have to then also submit more current payment and revenue information, expense information. So if your expenses, if you lost your job between the time you applied for the modification, for example, and now you have a decreased income, you may not qualify and you may fall out. So it's always pending their final analysis, and it's kind of a way to say, yeah, here is a trial mod. We haven't really approved you yet for the full mod, and so we do see that they're being denied the full mod. That is the trend, and that's all based on they haven't really reviewed all your documents when they give you the trial mod.
So let me split a hair here. Let's say you're in your 90-day trial mod, which I understand is pretty much the norm, and nothing changes on your part, and you make those payments. Shouldn't they adhere to the full modification in that case? Do they need the loophole if something changed on your side?
Well, I think that there's a lot of reasons why they can deny. If you're a microsecond late on any of the payments in the 3 months, you'll be denied. The other issue is that sometimes what we're hearing is that they never really, they thought this was 31%, so we're going to do it, but then they do, in the 3 months period, they start to analyze what your debt ratio is, and then they find out more information, and then they deny it, or they give you the full mod. I don't know if you're seeing anything different, Ben.
Yeah.
Okay,
It can also the factor could be their principal balance on their home. That in actuality they couldn't keep that interest down, so the payment's sustainable for the client. So that could have been a reason as they were reviewing all the information that was also a reason why they had to deny it.
But don't you think it's the average consumer's right out there that if they get a modification and they're in the trial modification, they can expect a full modification to follow?
I wish we had more transparency. It's kind of, it's a little bit of a false hope because you're in this trial modification. Trial meaning, okay, I'm going to, you said you want me to make 3 payments. I'm going to make it on time. Okay, I passed, and then you don't.
Okay.
So there is a lack of transparency there.
All right.
But it's getting better.
I'm going to jump to another call. Let's go out to Palm Desert. Patricia, it's your call. What's your question?
Hi there. I currently have a first and a second on my property, both purchase price money that I purchased in 2005. I've been late, haven't my payments.
Patricia, turn down your television for us. We're getting back feed.
I don't have my television on.
Okay, ask your question.
I'd like to know, my house is currently for sale on short sale. My lender, my first mortgagor, has agreed to a deed in lieu of foreclosure. My second, I would like to know 2 things. How will that affect the people that hold the second? And also, am I going to be responsible for the taxes on the difference on a 1099? I know the market is real crazy right now, and I'd like some answers on that if anybody can help me out.
Okay. Esther?
I'm going to defer to Ben.
All right, so the first thing, let's talk about if she gets rid of the home. Let's say it's not a foreclosure. Let's say it's a deed in lieu.
Right.
And the first agrees to that, but the second, be it a non-recourse, let's say it's a recourse loan like a HELOC. That's where you have the home equity line of credit and you've personally guaranteed it. If you have a first that's purchase money, that's what you purchase the home with, and you give a deed in lieu, does the second have to go along with that? Can they refuse? Can they keep the lien against the home? What's the ability of the second to block your ability to short sale or deed in lieu?
Yes, the second can definitely deny it. If they, especially with a HELOC or any type of credit line, they most likely 99% out of every time will deny the deed in lieu, because basically they would just be completely losing out. And then even with the deed in lieu, they wouldn't be able to 1099 them.
Okay, I want to get to that in a moment. What I understand, though, is that a lot of the seconds are really not in a position to enforce their lien because the house value has declined so much that it barely covers the first. So there's no reason to try to foreclose because they have to pay off the first before the second collects any money. So there's no reason for them to foreclose because even if they put it into a foreclosure, block the deed in lieu, put it into a foreclosure, auctioned it, they wouldn't be able to pay off the first and have enough left over to pay themselves off.
Right.
So they walk away. The second, basically just damages your credit, yells at you a lot, and
right.
takes it. Is that what you're seeing?
Yes.
I would say I agree with that.
So tell me a little bit about this whole thing. If you lose your house, you have the option of a foreclosure, a short sale, or deed in lieu. Those are the 3 most common I've heard. Only one of those prevents you from getting a tax ramification. Isn't that true, the 1099-C?
Correct.
So tell us about that,
Which
Ben.
would be the deed in lieu. Would be the only one where there's no tax ramifications on it.
Oh, okay, so you're correcting me. I actually thought a foreclosure was the one that legally let you walk away, but you're saying the deed in lieu does.
It's only the deed in lieu. Short sale and foreclosure, most likely you're going to get a 1099, depending on if it's a short sale, what the balance is. If it's a foreclosure, it could be for the full balance.
So explain to our viewers a little bit, what is this whole 1099 and the tax ramification of a foreclosure?
As far as
if you let the home go or you short sell it, you get this 1099. What does that mean?
Well, you would have to, what it means is you would have to include it in your income taxes. So you would have to claim it as income.
And claim what, Ben?
Claim whatever the amount is on the 1099. So which is called phantom income right now. So you would have to claim it on your taxes.
So when a bank forecloses, if they don't get the full amount of the loan by auctioning off the home, or if you short sell it and they don't get the full amount of the loan, anything that is missing, let's say you had a loan for $200,000 and the home sells for $180,000, they'll send you a 1099 for the other $20,000, and it's treated as ordinary income that's taxable. Isn't that the case?
Correct.
So I understand that there's an exemption to that.
Mm-hmm.
What is the exemption? Are you familiar with it?
Yes, it's the Tax Relief Act, which you would be able to actually write off that amount of the 1099 when you do your taxes, and that is, I believe they extended it out to 2012 now. So if you short sell or foreclose your home within that time frame, you would be able to write that amount off.
You're exempt.
Correct.
And I've heard it's extended to 2012 too. But what you've told us is that the deed in lieu actually offers that same protection. And I didn't know that.
Right.
All right, great. Let's go out to another caller. Let's go out to, and I want to say it's Leonard from Landers. It's your call. What's your question, Leonard?
I wondered about forbearance.
Okay. So
And, we're not behind in our payments, but do you have to be behind in your payments to apply for forbearance or not?
Oh, great question. Okay, we've heard a lot of people that say the banks tell them that if they're not behind, they don't give them the time of day. They don't do anything for them. So technically, do they have to be behind or should they be current?
Well, to make a home affordable is for current borrowers and delinquent borrowers. So there's help regardless. If you're having trouble with your mortgage, that the whole Obama plan, the HAMP or the MHA, is there to help you regardless of whether you're late or you're current. That set of forbearance agreement is trying to collect the money. It's not a loan modification. They just want you to pay your arrears, and whether they'll give you a payment plan of, let's say you owe 3 months and it's $2,000, so that's $6,000, and they'll over the next 3 months they'll add it to your current mortgage, so that you eventually just they want their money. That's pretty much a first strategy before they go and start talking about modifying the loan.
So that's where they allow you to basically waive making a payment for a certain number of months, or a reduced payment, maybe interest only, or whatever they work out. They just defer it, hoping that you'll recover. But it's not a modification under the federal program.
No.
And
Okay.
it's not when you go to the website and look at the 4 options for the making home affordable. It's refinance, loan modification, short sale, deed in lieu. It doesn't say forbearance.
But a forbearance is sometimes a gift to somebody that's temporarily unemployed, because they can get back on their feet and start making the payments again, typically. Is that fair to say?
It depends on the forbearance. We've seen forbearances that are not affordable at any rate. But typically, you might, I don't know, Ben?
Typically, a forbearance would be for somebody who, like you said, is maybe unemployed or maybe went out on medical leave for a few months, and the investor, the servicer, may see that they can afford future payments. They just maybe need those couple months of help. That's what your typical forbearance should be used for.
But what we've heard is this is bank's discretion. So whether you're behind or current is totally up case by case on the bank's choice.
Right.
All right, let's jump out to another call. Let's go to Redlands and Nancy. It's your call. What's your question?
Hello.
Hi, Nancy. What's your question?
Oh, my question is, what's the qualification to apply the modification?
Say that again. What are the qualifications?
I'm sorry, I'm kind of getting up now. My question is, what is the qualification to apply the modification?
Of getting a loan modification. What do you have to do to qualify? Say under the Obama plan.
Well, it depends on whether, with your current, if you're current, you may have the option of refinancing. In cases where you're not eligible for refinancing your current, you may also apply and be eligible for loan mod. If you're delinquent, you may be eligible for loan modification, but there is criteria in terms of, a lot has to do with whether your bank is participating in making home affordable, whether your investor is Fannie, Freddie, FHA, how upside down you are on the property. So there's a lot of different things that they need to assess. And if you have a question and you want to know quick and dirty whether you may be eligible, you can go on the Making Home Affordable website and plug in your numbers, and they'll do a quick calculation. But the only person that can tell you whether you're going to qualify is your servicer. So if you have questions, what I would encourage, is particularly the people who have not reached out to their servicers, is that the very first step is call your servicer, call your bank. They don't want the foreclosure. Everyone loses the foreclosure. And start the dialogue to find out and see if you're eligible.
One of the biggest criteria, I thought, for the federal program is you had to be FHA or Fannie Mae backed, your loan. If you had a loan that's completely owned by Countrywide or WAMU and it didn't have FHA or Fannie Mae, you're locked out of all these government programs.
No.
No, clarify that for me.
No, it's just like I was saying, if your investor is participating in the program, whether even if it's not Fannie Mae, Freddie Mac, or FHA, you can qualify for that program. But like she said, you would have to call your servicer, find out if your investor is actually participating and receiving that TARP funding.
Okay. Now, let's take a situation where somebody has met with a counselor, and the counselor has advised them that they may not be in a position to keep their home. What are the kinds of opportunities or services that nonprofits and the community reaches out and helps them with when they're going to lose their home? Maybe relocating them, or what are some of the other programs?
I think the first message that I want to get out there to everyone is that if you go to a HUD certified counseling agency, and they're going to tell you the truth, the good and the bad, and if they start talking to you about, we can maybe try for a mod, but you may have to think about how you would transition out of this home, that you really need to hear that clearly, because there'll be a scam artist out there to promise you that there'll be a loan mod, and all they're going to do is take your money. And in the end, you're going to have to leave your home anyways. And so there are ways to transition with dignity for a softer landing. With LANHS, we have a relocation work group. We have the Los Angeles County Apartment Managers Association who assist us to relocate families within their zip code. They don't do a credit check. They don't gouge you on the first and last month rent. And so there is help. And the bottom line is that not to wait until it's so far gone that you have a sale date and you've paid thousands of dollars to a scammer and nothing's been done, and at the very end you didn't hear that I think you need to move. And you really need to heed that and consider about how you're going to do that, because the clock starts ticking and it goes quite fast.
So you're advising that instead of paying the $1,000 or the $1,500 or $2,500 I've heard to these renegotiation companies that are not HUD approved, that they need to pay that same $1,000 or $1,500 to a HUD approved agency. Is that right?
No, we don't charge. We're free.
I wanted to get that out.
No, that's the whole point, is that help is available for free. We're part of the government effort in terms of we work with the National Foreclosure Mitigation Counseling. We're here to help, and we're here to advocate for you and fight for you to the end. If we really think that there's a loan mod in your future, we're going to help you. We're going to fight. We're going to get. We have legal partners that work for free as well. We're going to do everything in our power to do that. But if we really don't think that there's a loan mod, we're not going to give you false hope. We'll tell you straight up, I think you really need to start looking for help. But just like the first-time home buyers that came to class years ago, and we said, no, you're not ready to buy. There was someone there to say, yeah, we'll give you a loan.
And now you're telling people, perhaps in certain situations, that a loan modification really won't work for them. They need to look at transitioning. And you're saying now there's somebody else out there that'll say, no, I can guarantee a loan modification. All you have to do is pay me $1,500 for my services. What if that person's an attorney? I mean, even better than a counselor? Isn't it an attorney that's going to fight and get in there? And
well, that's why we have the public interest attorneys on our side who don't charge either, working for us. And unfortunately, and the city of Los Angeles passed an ordinance that you can't charge up front, but attorneys can. It's called a retainer. And so a lot of the groups are now working with attorneys so they can do that upfront retainer fee, and that's where they're getting caught. And I hate to say this, and I had one of our public interest attorney group members say, an attorney who said, they're giving us a bad name because they're the ones that are the worst of the worst in terms of...
The attorneys.
Sure.
Some of the private practice attorneys out there that have commingled now with these renegotiation firms that have just cropped up and are making an industry of collecting these fees from people.
Yes.
All right, I want to jump out and take another call. Let's go to Colton Florence. It's your call. What's your question?
Oh, hi. Thank you for taking my call. I'm 67 years old, and I would like to retire. I was going to sell my house last year, but then it went down like almost 50%, and my retirement and my 401k also did, and I'm getting all kinds of offers for reverse mortgages, and I was wondering if I should do that. I don't know the cons against it,
Good question. We hear about reverse mortgages. There's an age threshold, isn't there?
I believe it's 65.
62.
62.
62. Okay, Ben.
62 or older. And I think definitely a reverse mortgage is something that should be considered. A reverse mortgage is actually, for some people, the best thing. And with a HUD certified counseling agency such as our agency, we provide that counseling for the client to come in and sit down, and we give them, we explain the whole reverse mortgage process to them, the different type of mortgages that are out there, and see if it's something that may be in their best interest.
As I understand it, and I'm not an expert on reverse mortgages, we haven't covered that yet, and maybe we will, is you have to have equity in the home, because what the reverse mortgage company is doing is giving you a monthly payment against the equity in your home. If they're upside down in the home value because it's plummeted, are they eligible for a reverse mortgage?
No.
No,
they would have
just,
to.
It's just not going to work for them.
Yeah, right now, especially with like the HECM programs, they will only allow you to borrow up against 75% of the property value.
Okay, so Esther, you're from the Los Angeles office. Thank you for coming all the way in from Los Angeles to be with us today.
Sure.
And we have a caller from Los Angeles. Bob, it's your call. What's your question?
Hi, can you hear me?
Yes, again.
Yes, I actually had a statement and then a question. You spoke a little bit about short sales. Can you turn the TV down, please? You spoke a little bit about short sales, and I just wanted to for the benefit of the audience, let them know that some lenders are offering incentives of 1% back to the seller and the agent if they close within a certain period of time. So this is a way that if you are going to lose your home, check with your lender to make sure that there's an incentive available.
So you're saying, Bob, the incentive is to the homeowner's favor, or it's an incentive trying to get agents to work against you to foreclose out from under you?
No, this is an incentive to the benefit of the seller.
Okay.
And for example, Wachovia is one of the banks, and Wells Fargo that's doing this. Of course, they got stimulus money. But that's the first part I wanted to share. The other question I had is if you could address foreclosures as it relates to tenant rights in foreclosures.
Good question. I know that your agency works with that. I don't know that you're from that department, but if you know or are familiar with it, what happens to a tenant?
Okay. There are ordinances in place that protect tenant rights in terms of when we know families. We started seeing families who are getting notices of eviction who are paying their rent and had no idea that the owner was going into foreclosure, and so there is a protection on that. That said, there also, because the municipalities are in dire need of enforcement because of their budgets, like City of Los Angeles is in incredible debt, that the enforcement sometimes is not there in terms of protecting tenants' rights. And so one of the first things that I would say is that you need to know your rights. You can go on the LA County website and get information, and that there are legal public attorneys, public counsel, Legal Aid Foundation of Los Angeles, Bed-Stuy House of Legal Justice. I mean, I can go on that really help, and they're there to help with tenants' rights. And in the San Fernando Valley is the Fair Housing Council of San Fernando Valley, and they're dealing exclusively with renters. In parts of the city of Los Angeles, the foreclosures are multifamily units, and so they are protected under the ordinance in terms of their being evicted. I don't know what the Inland Empire what the laws are here, but there are. I'm sure that they're right. There are
Ben?
laws here.
I just wanted to make a comment on how he said that the servicers are offering 1%. They are. It's called relocation funds, and you can get that whether you're short selling or if a foreclosure happens, you may also be entitled to funds, which is called the relocation funds.
Is that the Cash for Keys program I've heard about? So
Cash for Keys, relocation funds, it's the same.
Okay, I didn't make that correlation. Thank you, Ben. All right, so we have had some attorneys for tenants' rights on. We had a whole episode on it. So I just wanted to recap what they told me. And again, you want to check with somebody that knows, not me. But I understand that California had if you're a tenant of a home, single-family home, and I believe this is true of multifamily, but I can't be sure, you had 30 days of protection. But in 2006, California raised it to 60 days. But then just in May, the federal government made it national that renters had 90 days before they could be evicted. If a home is foreclosed and they are renting in a home that was foreclosed, even though there's now a new owner, that they have 90 days of protection no matter what, even if the new owner intends to move in. And that if they have a lease in place that was put in place before the home went into foreclosure, went into default, that the entire term of the lease must be honored unless the new buyer intends to move in. And if the new buyer intends to move in, then they still have the 90 days.
Correct.
Okay, just wanted to recap that. I want to go out to a caller who I think wants a clarification. Let's go out to Palm Desert. Patty, what's your question?
Hi there. I spoke to you guys earlier, and first off, I'd like to say that you guys are a blessing for all the information that you provide in this crisis in this economy. But you mentioned something about either tax in effect or tax exempt on the 1099s that was extended to 2012. And unfortunately, I didn't get a chance to understand the terminology or what you said. And I was wondering if you could clarify that, please.
Sure. And that phantom income, I know, is the big gotcha. Most people think if the home is going to get foreclosed, they've gone through the worst of it, they've lost their home, but then smack. At the beginning of the next year in January, they get this 1099. Tell us what happens with that.
Well, with that, like I said, you would have to claim that on your income taxes as income. But with the Tax Relief Act, you would be able to write it off, or it'd be exempt. And
are you familiar with the qualifications for when you are able to write it off, what the criteria is?
It would have to be for purchase money. If it's been a refinance and there's been some cash taken out, and depending on what that cash was used for, it may exclude you from that.
So, okay, for Patty's benefit here, and for most people, because this is just a real gotcha that I know a lot of people have been hit by, if they got a loan to purchase a home, even if the lender is not made whole, the house value has declined so much that the first doesn't get their full principal back and the second doesn't get their full principal back, they can't come after you with a 1099 and actually have you pay the tax on that phantom income if that money from the first and second was used during the original purchase of the home. That's what you're calling purchase money, right?
Correct.
But if you later refinanced and you pulled money out and you paid off your credit cards and you bought a car and you thought you were making a financially astute move because the interest rate's a lot less than your credit cards, that's no longer purchase money, and you will actually have to pay the difference. Well, you'll have to pay taxes on the difference between the amount the bank gets back from the sale of the home at foreclosure or short sale and the amount of your original loan.
Correct.
I know that's confusing. HUD counselors can explain this. Is that right?
They can, and also the tax attorneys that we work with as well. The other trend that we started seeing very recently is that we had a couple clients come in that, subsequent to their short sale, got a promissory note for the difference. And so we're looking into that, thinking, okay, well, what's the point of the short sale then?
That's a new twist. I haven't heard that.
And so it's again, it's transparency and what we're looking for, so that we can advise clients the best way we can. And every bank's, every servicer, every investor, it's all about the investor.
Yeah.
And you may have 5, 10, or 1 investor on your property, so it's a case by case.
Okay, so we have other callers. Let's go out to Rancho Cucamonga. Pat, thank you for waiting. What's your question? Pat, you with us? Okay, let's circle back. Let's go to Santa Monica. Tom, what's your question? Tom on line 1, are you with us? Oh, Tom, we might have dropped you. If you're out there, please call back and we'll get right to you. Let's go to Riverside. Louis, you're on the line. What's your call? What's your question?
What will happen if a person gets a personal loan and the collateral is the home and person loses home? What's going to happen?
Okay, so if in this case his question, and I caught it, was the collateral on the home. If you have a home loan, the home is the only collateral. Is that right?
Well, as far as I know.
So we haven't seen a case where anybody's had any other collateral. If you lose your home, then you're done. They've got the collateral back.
Well, what we've seen also with small business owners in terms of their small business loans, and they're using their homes for collateral. And so when the businesses are failing in this economy, then their houses are at risk. And so that there's that ripple. And we work with the Small Business Association. We're a nonprofit for affordable housing. There are nonprofits that are for affordable small business loans. And so they're seeing their portfolio at risk because of the homes that were used for collateral. So it's also impacting their portfolios as well.
Ouch. Okay. All right. So, Pat, are you with us? Rancho Cucamonga.
I am.
What's your question, Pat?
My question is that okay. We have a home modification, and we're on the second home modification, but I'm disabled, and I just want to know.
Pat, you'll have to turn down your television.
To get the modification, and my husband works.
Pat, we're going to circle back to you.
Is,
turn down your television, and we'll get right back to you. Let's go out to Beaumont. It's your call. What's your question?
I have a cow. I'm a retired. Hello?
Yes, you're on the air. What's your question?
I am a retired person. I have a CalVet loan that is significantly underwater. As a retired person, I have some savings in the bank. Since my house would sell for significantly less than my loan balance, what are my options?
Okay.
Well, I mean, at this point, he'd want to check into a loan modification and see if maybe a principal balance reduction would be something the investor may consider. Also, a modification to maybe lower the interest rate and lower his payments. But like we said, it would all depend on the investor.
Okay. And a CalVet loan, does the CalVet backed loan qualify for the Obama plan? Is that kind of the same as Fannie Mae, or is it a different program?
You know, I'm not exactly sure, but I would think that because it's a government loan, and again, thinking about the investor, who's the investor? Isn't it the government? Isn't it a government-backed loan? That if it's a GSE, that it would. But that said, I think for seniors and retired people who are facing this issue, who are on a fixed income, it's difficult because Social Security doesn't pay what it, it doesn't nearly cover what the expenses for seniors, and so that 31% of income is qualified depending on what the rate is. If the rate was significantly higher, and there could be a reduction down to 2%, and there's a lot of things to take into consideration. And at some point, the decision whether you again, do you keep it or do you walk away, and it's a very hard decision. I think seniors are particularly hard hit.
All right, now we dropped Tom before, so my apologies, Tom. You're on the air. What's your question?
Yes, sir. I want to talk to you about a loan modification I'm currently involved in. I was only 6 months delinquent when a foreclosure sales date was set. As a matter of fact, it was supposed to be Monday, this coming Monday. In discussing the homes foreclosure program that I'm in with my K-backed loan with the lender, they told me they cannot foreclose while you are still being considered for the loan modification. If they haven't given you a yes or no, they would extend the foreclosure sales date, which in fact they did on their website. I checked, and now it's November 2nd. So is that typical that they will do that? They can't foreclose in this home affordability program?
Great question, Tom. Is that a rule, or is that just a guideline by the bank?
Well, first let me correct you. They many times will say that they will stop the foreclosure process while they're looking to modify your loan. And because of the sheer volume that especially the larger servicers are experiencing, the right hand doesn't necessarily know what the left hand is doing. And so it is really important that the client, that you call, you make sure you stay on top of them. Because we have had and we have seen where people were going through a loan mod and their house got foreclosed and got sold. And so it was just an issue of communication.
And that's what you're saying, they didn't even know that it was up for sale during this process.
Right. And so, congratulations that you took the initiative to check on the website to see that your sale date had been postponed, but you have to stay on top of it. And again, because the sheer, they don't, it's not anything that I think it's, they mean to do, but it's the right hand and the left hand don't know what sometimes don't communicate within this very large institution. They are now have a sheer volume that is this overwhelming, and so in order not to get lost in the lack of the paper shuffle, it's incumbent that clients really take a proactive approach to advocating with their servicer and calling them up and making sure that while you're on that loan mod and you haven't received that document to sign that yes, I'm going to agree to this loan mod, you keep in contact and make sure that your house isn't going up for sale. That's not supposed to, but we see it.
Right. And that's probably the most important thing is keeping in contact, knowing what's going on, because it could happen both ways. It is common that they may postpone the sale, and there's even been situations where they would say, yes, we will postpone the sale, and the client may not call in to check, just going on the word of the servicer, and they find out that their house has been sold. So it's extremely important to be on top of it and be in contact with them at all times.
All right, so now let's go back to Pat. Pat, we'll give this another shot. Hopefully you've turned down the television. It's your call. What's your question, Pat?
Okay. We're on the Bowman payment, and we made our second payment, and I'm disabled. My husband works for the city, and he has 2-day furloughs where they've taken off, and we just want to know if he, because I'm terminal, if we will be able to get okayed for our house. I've talked to Mr. Garcia because I've been in his office many times, and he's very knowledgeable and he's very good, and he probably recognizes my voice. This is Ms. Harrington, and we just want to know because we're in fear all the time. And now that I found out that I'm disabled, terminally, we lock the windows and we're very frightened.
Okay, Pat. All right, thank you for hanging in there. Great job on the question. So let's talk about this a little bit. Somebody, and I've had other callers that have had this situation. Somebody goes onto disability, and it's going to be long term, and their income power goes down. Is the government in a position where they can simply reduce your payments because they're nice? They're going to be nice to you and help you out in that situation, or must there be some capacity to pay back to the original level before they'll do the loan mod?
Well, with the Making Home Affordable, I mean, you definitely, that's two things that go hand in hand with that program is, can their current income sustain future payments, and can the investor get the balance down, or get the payment down, so that it does.
They need to get their money back ultimately.
Right.
Well,
right.
What we tell clients is that you enter into a financial contract with when you got the loan, and so now you're defaulted on that contract, or you're not making good on that contract. Before they renegotiate the contract, because you owe them money, they want to be sure that if they reduce the interest and do whatever they're going to do, that you have the ability to pay them back, and that you can sustain whatever payment that they come up with. And so when things happen, like layoffs happen and furloughs happen, and I think this is why we see conventional loans going to default that were fixed rate good loans by all indication, and then things shift, then that becomes an unaffordable, non-sustainable payment. And so that's so it's very important that you continue to talk to your lender. They don't know you're already in the trial mod and you've submitted your paperwork. They don't know that you've had a change in your circumstance, and so it's never too late to go back. But at the end of the day, the investor can say no.
Okay, and if somebody already has a loan mod and then their income gets reduced, can they get another one, or is that practically impossible?
We've gone back. We've had people who had loan mods before the Obama plan who now we encourage them to reapply under the Obama plan. And so we have had changes. And I hate to say this, but with the unemployment rate's so high in California, no job, no mod has been kind of the bank industry, slogan. And so it's all about, will this lender look at disability as income? And will they look at unemployment as income? Will they accept that you're renting a room to a cousin as income? And what is it and every servicer is different, the investors are different, so it's knowing what the box is for your bank and what they're willing to accept, and then packaging something to receive.
Right. We have other callers, and we're not going to get to everybody, but I want to jump out, and let's go to Compton. James, what's your question?
I was wondering, why don't they have some type of foreclosure insurance of some sort?
Foreclosure insurance. I've never heard that.
I've never heard of it either, but I never heard of people just losing their house because the bank can't pay for it.
Yep. So help us out. Why wouldn't there be foreclosure insurance?
Well, the investor has foreclosure insurance.
Yeah, they do.
It's called It's the PMI that they're paying. And it's called property mortgage insurance, and it's an insurance that guarantees them their money back if the homeowner forecloses.
But so far, nobody's created a business model that makes sense for the home buyer to have some kind of insurance against, say, unemployment or something. I've seen that with, like, we'll pay your credit card bills for a little bit or something like that.
Right, and the PMI is one of the incentives that they have, frankly, to go ahead with the foreclosure, because they will get their money back. At the end of the day, it's all about what's going to cost me less money.
All right, I'm going to jump to another call. Let's go out to Banning. Linda, what's your question?
Hi, I have right now I'm in loan modification request with Bank of America, and I've requested the loan modification because of a loss of income hardship since November 2008, where I lost part of a pension and reduced my income by half, which is now basically Social Security only. And I have a 30-year FHA loan on my home, which is now taking about 90% of my income to pay. And basically, that's not acceptable. And I've tried to put it on the market and sell it, and gotten no response there, which was what I was hoping to do. But my question is that I've had this modification request in with a HUD counseling organization, and it's been with this last one since the beginning of July, and I'm still not hearing any word about whether they're going to look at my modification request or not.
Okay. All right. So time frame this for us. Give us an idea of how long it takes to get a loan modification application in and get a decision back. What's the kind of time frames people should accept?
God, I wish I had an answer for you. Right. Case by case, it all depends. First, it depends on, did you have all of your paperwork, everything that was requested, all the I's dotted, all the T's crossed, and you submit it, and who, Bank of America, aka Countrywide, it's got a bigger value than, say, a smaller servicer.
Esther, I'm going to interrupt because we're almost out of time. Give me a short answer, if you can, for the average person. If it's been 2 months, should they be worried?
No, we've been averaging about anywhere from 2 to 3.
2 to 3.
It's about 30 to 90 days.
All right, I'm going to take one last call. Let's go out to Amy in Palmdale. What's your question, Amy?
My sister has a loan and it's under my mom's name. Now, my mom doesn't work, and she's my sister who's making the payments has been struggling. But is there any kind of hope for a modification for her?
Okay. And you only have about 20 seconds.
Yes, definitely. You can use, the servicers will allow you to use the household income.
Full household, and you talked about that just in your last call. Right. All right. So, and I want to recap. Is it up to the case-by-case for people to accept whether or not, like, your disability income or your unemployment income or your renter income is you rent a room? It's case-by-case, or they have to accept it?
No, it depends on the investor and the servicer in our experience.
Yes.
Okay, so it's case by case. All right, thank you very much to our viewers, and I'd like to thank our guests, Esther and Ben, for joining us, and thank you all for calling and for watching. If you'd like more information about tonight's show, go to kvcr.org, click on the button that says Facing the Mortgage Crisis. Please join us next week. I'm Roger Bowman, and remember, It's your call.
For more information about this project and related topics, visit kvcr.org and click on Facing the Mortgage Crisis.